So first and foremost, I think if there's a capital gains tax on principal residences, what you will see is less supply and a higher price. Why is that? In today's video, is there a capital gains tax coming for principal residences in the Toronto and Ontario real estate market? We'll get to it. Hello everyone, this is Sam from SaberiSixRealEstate and Remax Realtron Realty. As always, back with another video for you guys here today. As always, my contact information is in the description box with regards to my office, my Gmail, and my Instagram. Feel free to go follow me on my socials and get in touch with me if you have any questions about Toronto real estate or the real estate market, or if you need any help with any matters with regards to real estate, or if you just want to say hi. Lastly, as I always say, feel free to subscribe, comment, rate, and review if you happen to enjoy these videos or all my other videos. If not, feel free not to do so. But if you do choose to subscribe, comment, and like, your support in that regard is much appreciated. Now let's get to the point of today's video, which is a potential capital gains tax being applied on principal residences. First, let's shortly define the capital gains tax. Capital gains tax, shortly defined, as a tax applied towards capital gains, and capital gains is when you own capital on an asset and it appreciates in value. And once you realize that appreciation through proceeds of sale, so let's say you have an asset, you bought it at $50 and you sell it for $75, we call that capital appreciation or capital gains. And a capital gains tax is a tax on that $25 or however much, whatever hypothetical example we want to use, a tax on the capital gains you get from your asset. And naturally, capital gains, they serve several functions, but the primary function is they raise revenue for the government in question. So right now we do have a capital gains tax on investment vehicles. So stocks, there's capital gains tax on stocks, on real estate property that are for investment purposes. However, talk, as I said, is now of a capital gains tax being applied against principal residences, not just investment properties. Because as of now, principal residences are exempt from capital gains tax. So why are there proponents of this and why are there detractors from this, right? A lot of people for this idea and there's a lot of people against this idea. Prominent economists, a lot of prominent journalists, and a lot of common day people who are buyers who are very much so disenfranchised with the Toronto real estate market and have a very cynical and pessimistic outlook towards their hopes in terms of ever purchasing something in Toronto or the GTA. They are in favor of this tax because they believe this tax will help cool the market down a bit and give buyers a little bit more advantage once again in terms of actually being able to afford something in this market. So in short, the proponents of this capital gains tax idea for principal residences believe it will be a good measure to help affordability. Whereas detractors, the opponents, as opposed to the proponents of this idea, are a lot of real estate agents, my colleagues, people in my industry, the Toronto Real Estate Board, a lot of not just real estate agents, but a lot of investors, a lot of financially minded people who are very much so involved in the market and own a lot of capital. They are against this idea, and also a lot of common day people as well. And their reasoning is obviously that this would be bad for the real estate market or the economy at large. So what is the truth here? Well, I'm not going to provide my own opinion. All I'm going to do is break down the consequences of a capital gains tax if it were to be applied for principal residences for the Toronto real estate market. Once again, I will not provide my own opinion. I think those who might know me a bit may know where my opinion lies. I'm just going to go based on rudimentary and basic microeconomics and explain, according to rudimentary and basic microeconomics, what would happen if there is a capital gains tax applied against principal residences. So what do I think will be the consequence of this on the Toronto real estate market if there is a capital gains tax applied against principal residences? Once again, this is not what I think ought to happen. This is what I think will happen. So first and foremost, I think if there's a capital gains tax on principal residences, what you will see is less supply and a higher price. Why is that? So in microeconomics, there's something called a debt weight loss. A debt weight loss is basically additional, extra, unnecessary cost to society caused by a market inefficiency. And that market inefficiency is in turn a consequence of when the supply and demand are out of equilibrium. So you don't have market equilibrium for supply and demand. And the result of this debt weight loss is less supply and higher prices. So in my opinion, once this capital gains tax is applied, which once again, nothing has been decided insofar as will it be applied or not. But if it is applied on principal residences, in the short run for sure, and in the long term, I think you're going to see less supply on the market and higher prices for that supply. So why is there going to be less supply? Well, think of it in terms of common sense, right? When you have no tax to pay, no potential additional cost to you selling your property, to you liquidating your property, you are more likely, if the case does arise, putting aside your emotional attachment and if you want to move elsewhere, if we're just looking at the numbers, you're more likely, if it makes sense to you financially, for you to go ahead with a sale because the costs are minimal. However, if there is a capital gains tax on your principal residence, you're less likely to sell. Thus, as a result, you're less likely to list it for sale on the market. This has a consequence of reducing inventory. In terms of prices, well, if you do choose to sell, what will you do? You will price in your costs in selling. Another related impact, I think, is what we call in microeconomics. And when I say what we call in microeconomics, I don't know why I said that because I'm not an economic professor. I did study economics, but I'm not an economist. I'm a real estate agent. So what economic professors and economists call the locked-in effect. There was actually a very interesting study I found wherein two economists studied in the late 90s, I believe 1997, the consequences of a marginal tax like a capital gains tax on the transactions. But this was with regards to the stock market, right? So stocks are a much different story than real estate. Stocks are much more liquid. Stocks are, in theory, infinite. Real estate is not that liquid. Real estate is, in theory and in practice, finite. So there's a lot of differences, but there's also a lot of similarities. Insofar as there are similarities, these two individuals studied the stock market and trading of stocks, and they found with the capital gains tax, they found out that with each 10 percentage points increase of a tax in terms of capital gains, the owners of the stocks were 6.5% less likely to sell the stocks and hold on to the stocks. So there's the lockdown effect. What people call in microeconomics as the lockdown effect is sometimes, a more common sense way of explaining the debt weight loss created by any tax, especially a capital gains tax in this case. Anyways, that's Sam from SaberiSixRealEstate and Remax Realtron Realty. Thank you for watching. As always, subscribe, comment, rate, and review. And yeah, tell me if you have any further questions.